handle the truth. We have to let the Reddit people really kind of get cleaned out, get their clock cleaned.
Our biggest worry is stagflation. We have nowhere to hide.
So overvalued. They're at 100-year highs. I don't know what you do. I know one thing I'd want to do is the one thing that can hurt that is inflation. I'd have as many inflation hedges on as I possibly could.
Rick, when you print a lot of money, it's got to go somewhere. It takes a long time to build a factory. It takes a long time to build a bridge. You can go online, and in 8 seconds, you can buy a lot of Microsoft or anything you want to, and that's what's happening. Stocks and bonds all over the world are going through the roof because all this money has to go somewhere. But I'll remind you, somebody's got to pay for it someday.
Probably the biggest bubble ever. What happened in Japan in the 1980s. There were more bears at 25,000 than there were at 30,000, and many more at 30,000 than there were at 35,000. And the eventual collapse came at 39,000. I see that as a concern right now with our markets.
I mean, these are numbers that remind me of the 1970s. In fact, a lot of things remind me of the 1970s. You know, we're just pulling out of a failed war in Afghanistan where we basically fought to a stalemate. It kind of reminds me of the 70s and Vietnam. And we had guns and butter that led to inflation in the 70s and the late 60s and the 70s into even the early 80s. And we certainly have guns, butter, student loan cancellation, free unemployment benefits, and everything else. So we're going kind of full tilt.
But if they cannot sustain these new highs, and given their predominance in the indices, that may be setting up for a sizable reversal.
So this is massive, and if the economy shows any weakness after that much stimulus, I think stocks could go down. But I think the trigger may first be now that maybe the markets do have to get real about inflation.
It's starting to happen. Some of us have lived through inflation in the past. We've certainly read about it. And when prices go higher and higher, it usually causes distortions in your economy, in your life, your children, your savings, everything. It gets messed up.
The idea that inflation is transitory, to me, is $88 trillion of assets under management by asset managers. Certainly the impact models that we run would argue that GSER or BCOM would double or triple. So you've got, if I just look at where asset managers are, 60-40 types, the one thing that they should be invested in, they're not invested in, probably because they're hearing these assurances.
What do you say? Is inflation here to stay?
Inflation's here for a while. We're getting the whirlwind of what was done last year and the year before. Even before COVID, Stuart, the Fed was printing too much money. They went on a binge last year, perhaps for understandable reasons, but they overdid it. And then I think everyone's underestimated the huge disruptions, supply chains disruption when you shut down the global economy. It's not like a light switch. But I think some people at the Fed, even if the chairman remains happily oblivious, are beginning to realize, Stuart, the party is over.
The savers are getting slammed. Many of the savers are now more confused, and I think some of them are now finally entering in equities and other asset categories as a part of it.
The United States market has been going up for 12 years now without a serious problem. That's the longest in American history. Maybe it's going to go on 112 years without a problem, as Yellen says it will. I would suspect we're getting closer. I'm starting to see signs of bubbles developing in bonds, some stocks. I'm not selling out yet by any stretch because the bubble's not everywhere, but it is forming. And I would suspect within a year or two, we're going to see serious problems. We're starting to see inflation. Now,
what is a bubble? What do I mean when I have a bubble? Because I watched a lot of bubbles over my something like 50 years of investing. There were 6 things that made a bubble in my mind, and I'm going to rattle them off, then I'll apply them so that you know what I think. You can't say the stock market is in the highest a bubble. You can't even say that it's necessarily in a bubble. You have to distinguish which stocks are in a bubble.
Here, the bulls are going to begin to lose some of the upward push. The market historically from June into the middle to late 2/3 of July has an upward bias. That is dissipating now. So we're going to have to fight.
Notion that there could be moves, maybe 1% or so up or down, but that nobody's really playing it. Is anybody really going career long or short this market in July or August?
I don't think so, Dom, and I think that's the right course of action. That's why we're neutral. We're not betting on the downside, and we're not betting big on the short-term upside. This is what happens in a transition, right?
I think we're going to have an extremely strong economy come the fall. I think people are going to return to work in September. They're going to have fun. They're going to go to restaurants. You're going to see a massive, in my view, economic boom.
I'm not buying that this is the end of the bull market. I'm saying that most of the companies that are involved with technology would roll it over for days, maybe even weeks, and suddenly everyone's discovered that.
And look at where we are in the economic cycle. And the U.S. really has just entered the expansion phase of the economic cycle.
Really? Fundstrat's Tom Lee just hiked his year-end S&P 500 price target by 7% to 4,600. That ties for a street high. Tom joins us right now. Tom, great to have you with us.
Great to be here.
You're not worried about slowing growth compared to earlier this year? An economy that reopened in the first half of the year and an economy that will sort of normalize in the back half of the year with the threat of tapering in some form?
I think that, I don't think recovery is a straight line up, but from what we can tell, looking at both earnings revisions and conference calls and really talking to clients and businesses, I think there's still quite a lot of pent-up demand. I think both on the consumer side, right, there's the revenge spending, and then with both wealth effect and rising stock prices, strong credit markets, I think there's a corporate CapEx cycle coming, which is essentially corporate revenge CapEx. So I think there's a lot of positive catalysts for surprise in the second half.
I just believe that unless there is another unforeseen event, like a virus that spreads across the globe, or some kind of disaster occurring, there is not going to be the market crash that folks are looking for or calling for, because fundamentals continue to be strong and the macro environment is continuing to provide stimulus for growth. So those companies that are growing will grow faster, and those companies that are failing to achieve growth for whatever reason, or because the business line that they're in is different, like for us, companies in the utility or energy space that are going to have a hard time continuing to grow, but companies in the technology and financial space are going to continue to grow. So I do not see anywhere out in the near term or even reasonable midterm a stock market crash like some of the others who I've addressed on your show in the past have called for. It just seems completely irrational to me.
As someone who speaks for $1.5 trillion, David, is now still a good time to be taking risk, or is now a time to get cautious?
So the dominant fact of the investment landscape today is that it's never been more punitive to hold cash. Full stop. For the last 24 months, that's been true, certainly in the United States, but even more true actually around the world. And what that's doing is driving unprecedented amounts of money out of government bonds and into higher risk assets, certainly including equities, but also including a wide range of other alternative assets, where we see the search for yield just intensify. So I think what you have to believe about valuations today is that those are supported by a view that rates are going to stay low for longer. That's a view that we certainly have, but others have been pushing back hard against that, and time will tell. Well, we believe that risk assets are attractive today, and we certainly are constructive on risks. We're mindful of some places where pricing has run ahead, but broadly, there's plenty of risks in the economy. But our base case is for the next 18 months to have very strong economic recovery and economic performance right across the developed world, and including China.
Wall Street to up its full-year projections, or are we expecting that pullback others are saying is headed our way? What do you think?
Well, first off, I think every analyst may just retire now and give up because they're never right. But I think the bottom line here is it just shows you how wrong Wall Street's been all year. I mean, if you look at earnings per share on the S&P 500. Every single quarter that Wall Street has to keep upping their earnings estimates because they've been so off. By the end of the year, they could be wrong by like 40% based on what they thought at the beginning of the year. So I think there is a narrative right now, because we did see a little selling earlier in the week. Didn't last that long, but we did actually finally get a little bit of selling. But are we getting to a point now where the markets are peaking out? We're at all-time highs. We have this proverbial sugar high because the government's created trillions of dollars that have just been bestowed upon the economy. And I think we have to look at is momentum right now, Adam, is just so awesome. If you look at the S&P 500 over the last 5 months, it's been up over 5% each month consecutively, which is the first time since 1956. And when that happened in 1956, the market went on to go up another 25%. Could we see the same thing right now? I'm in the camp to say yes, we could see a melt up here.
Might be on the flip of that right now. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market, the equity market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies.
When it comes to trying to figure out things, it's not that my opinion doesn't matter. See, my job is to figure out what the big buyers and sellers are thinking, not what Jim Cramer's thinking. I know what I'm thinking. But if Theory 2 is right, how do we explain the weakness in so many parts of this market, including areas that should be thriving in a peak inflation scenario? I think I have it. And it's none of those. None. Okay? I think right now we have a lot of speculation in the system. In part because the government's given away so much money. In part because there's a new cohort of investors, younger people who tend to borrow money to buy everything from Bitcoin, which is being crushed, by the way, to all sorts of high growth stocks that they don't know the first thing about. And of course, all this junk that they keep taking up that probably should be much lower. These younger investors seem drawn to technology, biotech, crypto, meme stocks, the latter being the unfortunate name for the stocks that have become playthings for the Reddit contingent that keeps trying to game the ungameable. I think these speculators are starting to get blown out.
You still holding on to all those OEX contracts?
Yeah, you better believe it. Why, you nervous?